When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about markets, inflation, and what retirees should do in 2026. Also, retirement risk that didn't exist 20 years ago. We'll answer listener questions. And then finally, how to prepare for potential inflation this spring. My name's Jeff Shade. I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how are you today?
Doing great. How are you doing?
I'm doing fantastic. Early part of January here. Can't wait for 2026 to unfold. A lot of good stuff to talk about. So let's touch on current event headlines here today, Jeff. We're talking about what's happening in the market right now and more importantly, what it means for retirees and investors in 2026. Reuters is reporting that investors are flagging something that they're calling AI-driven inflation. Markets are optimistic about technology growth, but there is some concern that could actually push inflation higher. How does that happen?
Anytime the economy starts moving along and creates more money, creates more wealth, the rich are getting richer. I don't know if it's really affecting the lower to middle class, but just that increase of wealth alone is going to put pressure on the inflationary pressures. The other thing is you've still got some kind of QE leaning programs with the Fed. I mean, they've kind of tightened lately, but this AI craze has created a lot of money momentum, and it appears that overall, the economy isn't lagging quite as much for businesses in Wall Street as it is for the average Joe. So unfortunately, when that happens, rich people and people that are in the market taking advantage of this AI boom are not going to be hurting. They're going to be excited to be happy to spend money on whatever and pay whatever they want. And, if there's any supply chain hiccups like kind of started and we still haven't really recovered fully from is from the COVID crisis. When everything was shut down, we're still kind of getting back on our feet from that. So until we get this tariff deal moving companies back to the U.S. and the infrastructure builds up and we start getting supply up and running at a more robust level, I think we're going to see a little bit of inflation. And, it could be, you call it AI-driven inflation. I don't think AI in and of itself is an inflationary thing. The biggest fear is how many jobs is it going to take? Is it going to actually create more jobs? There's two trains of thought on that. Is it going to take jobs and we're all going to have to live on extra taxes for the billionaires that use AI and are getting rich by AI and basically become more of a socialistic focused country? And I hope not. Or is that extra income going to cause those people that are taking advantage of the AI economy to buy more things or to create new businesses or create new leisure activities? And who knows, maybe pay more for help and, more personal services. So maybe that business grows. Maybe because of the money, there increases all kinds of different avenues for financial growth. So kind of deviated from your question a little bit on the end there, but I think AI is putting a lot of fear into people because what is it going to replace? Also, how much is it going to own us? And how much are we going to rely on it to where if the power goes down or the internet goes down, all of a sudden we can't use AI, nothing works. There's still a lot of what ifs about it, but because of the hype, just like the .com bubble that grew and then popped, I think we still might see an AI bubble where the best and the biggest and the most prepared companies that have the best technology and the best investments and the best business plan are going to emerge winners, and there's going to be some losers in that too. So anytime we have economic boom, we have to control inflation or be careful about inflation. And the only way we can keep that down is if supply can outpace the demand to keep, and if those cost of goods and cost of services that go into creating products and services can actually lower the prices, then we can keep a nice low rate of inflation increases, which we used to have. I think COVID kind of put the dampers on that, even though we were printing money for years since Obama came into office. Once they started fixing the market crash of '08 with QE, quantitative easing, printing money basically, as long as the supply chain kept up and as long as, there was a little bit of inflation, but inflation really wasn't out of control. The stock market went crazy, but it didn't mean everybody was selling their stock to buy stuff necessarily. And things were readily available, especially cheap things. As we exported all of our manufacturing to other countries that could do it cheaper. But that's coming back to haunt us because now we don't control it. Now those other countries can pinch us if they want to, and we're not in control. So now inflation is a real thing that we have to worry about. And I think we have to be a lot more careful as the economy booms with the AI growth, that it doesn't filter down to really create more division between the classes of the rich and the poor, meaning what used to be the middle class. It seems like the middle class people are having a harder time. Healthcare subsidies being reduced, people having to fork out more costs for especially healthcare. Food's gone up. We've got, thankfully, energy prices are going down, gas prices are going down. That should filter into the food prices. Mostly they've stabilized a little bit and are coming back a little bit, but we still are sitting on 30 or 40% inflation, gross inflation, since Biden took office in 2020. And those 4 years are still haunting the pockets of most Americans. So inflation is not a good thing. We don't want inflationary pressures. We're seeing a lot of that. The Fed isn't really helping that much. Lowering interest rates, on the short-term interest rates is just really lip service that makes the market feel good. But if you look at what's happened to the bond market, which actually drives interest rates, the bonds have largely trended down in the last year or two, not up, flat at best. And we're not seeing mortgage rates come down. We're not seeing cars. I mean, financing cars, they're bragging about it. We can get you 7.9% on a 60-month loan. Like that's some kind of big deal. I don't remember the last time I even was offered a 7% loan on a car. I mean, I typically buy them cash if they're that high, but I used to get 2% money and happy to borrow money at 2% when I can invest at a much more higher rate. So now it's cost of money is hard. People are using their cash to buy stuff instead of invest and grow their own net worth. And inflation is going to take a bite out of, I guess, the average consumer is going to feel it more than the people that are actually taking advantage, that have money, that are taking advantage of the AI boom and the fact that the stock market and other things like gold and silver are increasing in value. So it's a good thing and it's a bad thing. I hope it filters down and I hope the economy can help everybody. I don't think it's a job for the government to take all the money and to redistribute it and be the managers of money. I think we just need to make sure that we find opportunities during this AI boom, not to displace jobs, but to increase opportunities for better paying jobs and other economic avenues to grow wealth and to grow middle class stability and continue to have a middle class. Because I think that's the part that's dwindling. The middle class is separating into two, those that have and those that have nots. We want inflation not to hurt it any more than it already has. I think it's been pretty good lately. We're down below the 3%-ish level or right around there. Haven't got under 2, which is kind of the mandate a few years ago. They kind of stopped when it was around 3 and said, well, we're probably never going to get to 2, so I guess 3 is okay. I don't know if 3 is okay, because the thing is you're looking at overall inflation. You're not looking at those things that really matter, like the healthcare, food, gas is down, housing is up, borrowing money to buy houses and things like that are keeping people kind of stuck in their old houses, which means the real estate market is not turning over. That's not creating there's no economy growth there, or very little, if any. And I know we're seeing kind of almost still a stagflation type economy, in my opinion, even though that, there's supposedly the GDP is growing, but I think that's a little misrepresentation based on just mere population growth is going to help that. I think we'll get some growth as Trump's policies, because they're good business focused policies, get implemented, as manufacturing and infrastructure continue to grow, as the AI business continues to generate additional growth. I think we're going to see a healthier market, a healthier economy ahead, but I'm still worried about any corrections along the way. Due for a while. If you look at economic indicators, which are still going down, if you look at the total economic indicator index, not just a couple of things that seems to be doing all right, but if you look at the overall health of the economy, I'm still skeptical as to if we're on good footing. And certainly inflation is going to be a hindrance to that, not a help.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. If you want a clear picture of your retirement in today's market and with today's economy, call 520-780-9059. Ask for your Premier Retirement Roadmap at no cost and no obligation. Once again, that number 520-780-9059. A few minutes ago, Jeff, you mentioned the word bubble. Ray Dalio of Bridgewater says the AI boom may be entering bubble territory. Should retirees be worried about AI getting into a bubble?
Well, of course. Some people think it's already been in a bubble. I think Ray Dalio is probably one of the smartest people that investors that ever walked the planet. I think Warren Buffett's kind of the old fundamental guy. He got his stock by doing mergers and deals mostly, and then just buying and holding some good, solid blue chip companies. Ray Dalio is a little bit more diverse than that from the standpoint of where he goes and makes his money, and I believe has probably outperformed Buffett over the years. I believe he's in retirement now, kind of handed off the baton, kind of like Buffett did in Berkshire Hathaway as well. But Dalio is still probably one of the most knowledgeable person about credit risk, credit in general. And I'm not talking about credit cards. I'm talking about the Fed printing money, how much we're going to borrow to stimulate the economy, how much we're going to actually put back into the economy that creates actual returns rather than just fake returns through some of this money printing. It's not really printing money, but it is really a fake economy when you generate fake values. When banks don't really have money, they just have it kind of handed to them to do their business. I think Ray Dalio he's a historian. He looks at all the past bubbles. He looks at history back to Roman Empire and how the government got too big. They got too pompous and arrogant, kind of like our government is. I think they could just take money from everybody and continue to grow the economy by stealing and spending it. And pretty soon there's no taxpayers that are willing to work or interested in playing the game anymore. And there becomes not enough people to pay the taxes to keep the elite in place anymore. I think we're rolling that way eventually. Ray Dalio has talked about that too in different things. But as far as the current topic that he's talking about is being nearing a bubble, is when there's a euphoria and a frenzy where everything that has any connection with AI, or if a company says, and I'm not going to name the name, but there's a cosmetic company that was supposedly getting into AI. They call themselves an AI company, but they're using AI to sell product. It's still a cosmetic company, but because they put a tagline on their marketing as it has AI in it, everybody's buying those kind of things. But there's a lot of things that are going to get shaken out, I think, in the end, just like in the dot-com bubble where it went .bomb, we might see an AI bust. I think we're a little bit ways away to see who's going to emerge the winners. I believe the energy sector, as far as the nuclear, the power centers, anything that generate tons of electrical power to run these chips, cooling technology to cool them down, all the things that go along with this extra power that's necessary to run AI, that infrastructure piece is probably going to continue to be strong. But if you look at some of those companies, they're so overvalued. They're trading at what they probably should be trading at 3 or 4 years from now. And hopefully they'll be valued at that price. But as people are willing to pay that money now, are people going to continue to still buy 3 or 4 years ahead of schedule on a continuing basis? Or are we going to finally get down to a more perfectly priced market where everything makes sense again? I don't know. Maybe we will, maybe we won't. I think we need to follow the money and watch what the market's doing. And as long as they're willing to overpay for stocks, I guess we can be willing to overpay for them too. But we have to be very careful not to overextend our risk and be ready to be very nimble and agile as we invest, because if the market starts selling off at the values where it's parked at right now, it could be harsh. I mean, it seems like the longer the rubber band is stretched, the harder the snap's going to be. And I think we're getting into those territories now where we have to be very careful. I'm definitely not going to say that the market is done running, but I'm also not going to say that the market is fairly valued. It certainly isn't. Again, it's always be cautious. I mean, there was a time when I just thought the risk was way too high. But the hype and the focus and the excitement about that sector of AI has propped the market up and, it's given it some confidence that can probably carry through some of these economic numbers that aren't really too thrilling. But, we can push through and maybe, who knows, maybe we can get earnings eventually to come up to where they should be. And maybe we won't have that recession that I've been talking about, Ray Dalio's been talking about, Buffett's been talking about, all of the big money's been talking, all the smart money's been talking about, and still are talking about it. Because, they're sitting in cash, a third or more in cash. Most of the big hedge funds, institutions, the Buffetts and Dalios, those guys are all going to cash and they're waiting to buy cheap. So I would say, when smart money does stuff like that, we should listen, we should pay attention and be very careful. Fortunately for our company, we're really small. We're not managing $1 trillion like Buffett. We don't have to raise $300 million. If we wanted to go to cash, we could do it in a couple of days. He's got to do it over years, because if he sold all the stock that he owns, he could shut down the market, shut down trading on a daily basis, or drive those stock prices to the floor before he gets out. So those big institutions have to go about it a little bit more methodically. And we've been seeing them reduce their positions in the market over the last year or two, actually more than that for Buffett lately, especially. If Ray Dalio says, Bridgewater's going to cash and waiting for a correction because the AI is getting into a bubble territory, that doesn't mean he's not in AI stocks. I guarantee you he is, but he's also got some cash where he can buy those stocks back at a much cheaper price when the market sells off. And I think all there has to do is be a big scare. And once that selling starts, we're probably going to see some follow through, and the dumb money or the street money, the Main Street, is going to get scared and probably try to lock in profits, which isn't necessarily a bad thing if you try to lock in profits. But the first ones out usually win, and the last ones out usually really lose, because the last ones out are usually getting out right at the bottom, right when there's no more sellers, and the big money's ready to swoop back in and buy cheap. So take that all with a grain of salt. Take it for what it's worth. Ray Dalio's a smart dude. We should never discount anything he says. I look to those guys as my go-to people for advice, not because I can call them on the phone, but I mean, whatever they're saying, I'm going to be very conscientious of what I'm doing based on what they're saying and what they're doing, not just what some marketing dude on TV like Kramer or some of these talking heads on the tube that are trying to sell advertising space, say what you want to hear. I think Dalio, Druckenmiller, Buffett, those guys, when they talk, I don't think they're trying to manipulate the market for their own benefit. I think they're just wise dudes that want to share what they're feeling so that maybe they can help a few people not get hurt when the market does its correction that's long overdue.
Our program is called Premier Retirement. We're talking with Jeff Hogan here of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about current events. And again, if any of this sounds familiar, market ups and downs, lower interest rates, concerns about income lasting as long as you do, there is an easy next step that you can take, and that is to call Premier Retirement and request your Premier Retirement Roadmap. 520-780-9059 is the number to call. You can call that number right now. Leave your name, telephone number. Shelley will get that. She'll call you back during the week and set up that appointment for you to talk to Jeff here at Premier Retirement. No cost, no obligation, and no judgment. Once again, that number 520-780-9059. Jeff, let's shift gears here a little bit and talk about how retirement has changed over the past 5, 10, 15, even 20 years. Retirement planning used to be fairly straightforward. Income planning, tax planning, Social Security optimization. What's changed in the last 2 decades?
Well, I think just the product selection is wider. There's been products that have been designed to specifically provide the services and the needs for a retiree that's going to last a few decades rather than a retire that's going to retire at 65 and die at 70. Like in the old days, people didn't even live to age 65, let alone, half of them didn't even collect Social Security. But now people not only are collecting Social Security, they're collecting it for decades. And whatever they've got saved in the market or in investments, they also have to make last that long. It used to be that everybody just had a retirement, they saved and probably lived on a pretty tight budget. They weren't spendaholics like we are nowadays and probably lived within their means. And so they may not have had to even spend a lot of that market risk type money. But as we've gotten bigger and bigger returns, people have started amassing millions of dollars in retirement funds, left it in the stock market. We realize that volatility will kill a retirement plan if there's a few market corrections and you're taking money out of those accounts while the market's down. So as the industry has looked at this, now the Wall Street really hasn't spoken to it. All they've said is, oh, don't worry, the market come back. We want to keep managing your money, taking fees and trading and everything. But the insurance companies, especially, and private equity companies have come up with different types of accounts that are either guarantee or can give more predictable income than, say, the stock market. The stock market, you can't really give predictable income. The stock market averages about 10% over the last 100 years. The bond market's 4 to 6% over the last 100 years. And you've got a 4% rule that says if you take more than 4% out, less than each of those average returns generate, somehow you could run out of money in 25 years or more than 25 years. So don't take more than 4% or you could run out of money. Well, how is that even possible with those average rates of return? Well, Wall Street doesn't want you to know that volatility affects your investments. They want you to just say, well, the 4% rule is great. Just keep your money here and hopefully we'll keep growing it and hopefully you'll have money. Well, I don't think that if somebody's giving you an answer like, hopefully you'll be able to retire and hopefully you'll be able to have money and hopefully your income won't run out, that's not a good plan. How about a guarantee? Hey, we're going to guarantee based not only on the security of the insurance company, but on the reserves that it has, on the extra money that it has, on state guarantee funds and different security measures that have taken place to guarantee and to secure the principal on those accounts where you aren't having to take risk. You can actually hand off some of those assets that you've grown responsibly by dollar cost averaging into those market-based accounts over the last 10 or 20 or 30 years, however long you've been doing your 401k and investing. Maybe you got some real estate that's grown. You want to downsize, take some equity, whatever. You get that money out. Why put it back into something that's risky that you could lose everything you've worked for when you don't have a job when you're 70 or 75 or 65 or whatever it is that you decide to retire? The nice part is the industry in general, and mostly the insurance side, which I think Wall Street is not very happy about, has stepped up and says, hey, we'll build products that'll guarantee income. How about you only put half your income instead of put your whole, I'll just use a term, $1 million, instead of putting all $1 million in there to get $40,000 of income and having that money basically tied up to provide income. And then you don't have any more savings other than what you might have in the bank or anything over and above that million. Maybe you have a lot more, but let's just say all you have is $1 million. And you say, well, if I've got it all in the stock and bond market, 50-50 split or 60-40, whatever the market says is wise, I can take 4% out. That's $40,000 a year. The market might do well, and you might be able to up that a little bit. The market might do horrible, and you might be glad you're getting $40,000 a year because the market's down, and hopefully you won't run out. Or you can put 50 or 60% of those funds into an indexed annuity with an income rider guarantee guarantee income so that no matter what happens to that $600,000, let's just say it's $600,000, you'll have $40,000 a year to live on. Same money, only you don't have to worry about that money going up and down. The insurance company takes all the risk. In the meantime, you have $400,000 that you can put in the market. You can let it grow. You don't have to rely on it for income. When you have a good market year, you take a little bit extra out and you take a nice vacation. When you have a bad year, you don't worry about it. You wait because it'll come back. If you're not spending it, it will come back over time. So you have the best of both worlds. I think the stock market is still a great place to put money you don't need to live on a regular basis. I find it interesting that even though I love that model, 60% is something that guarantees you enough income to live on, which is about the ratio that you would need in an income type account that's insured and secured compared to the 4% rule, you'd still have about 40% of your money that you can invest. It's interesting that most of my clients don't want to invest all the other 40% in high risk, even though they have 60% in zero risk or very low risk. They don't even want all 40% in stock. They typically want a 60-40 split on that stuff too. So we don't necessarily have to risk all your money, but if you have all the income you need and you don't want to worry about your money anymore, you can take as much risk or as little risk as you want. I mean, even if you made 5% a year on the other 400,000, you didn't need to spend it, it's still going to double every 12 years or so. You know, you've got more options now. So I don't know, do you want to call it more complicated? I think it's just more flexible. And because of the opportunities, the only reason retirement is more complicated today is because maybe somebody has to listen to somebody other than their stockbroker that only does stocks and bonds, parks your money, holds it and just says, don't worry about it. It'll come back and just take this much money out. And they go out and golf and play every day. And somebody watches your money from time to time. It is pretty much a park and hold, see what the market does type portfolio. You know, we'd rather have you have security and then have active management on what's left. And we don't golf and play all day. We actually watch it on a daily basis. We make active trading in our managed accounts. We do a very tactical approach because we think that's what we're getting paid for. If you're going to pay us a fee, we might as well watch it every day and make a change every day if we need to. Again, it's a kind of a different approach. We think it's better because we use the full spectrum of products and services out there. We add tax planning. People are in higher tax brackets now than they used to be. Typically used to be people would retire, go into a lower tax bracket. Now people retire and many times, most often, they're in a higher tax bracket. So now there's tax planning has to be included. Your broker dealer, if you're dealing with one of the big named broker dealers, they disclaim or they will not give you tax advice. Say, talk to somebody else. Talk to your accountant, talk to somebody else. What about insurance? What about a plan for long-term care? What a plan for life insurance? Do you need tax-free income? It's not that retirement planning has become complicated. It has given you a chance to get more educated and do so much more with your retirement to give you more peace of mind, more flexibility, more confidence in your retirement, and the ability to retire on your terms instead of retire on the terms that the market might provide that are hold and hope or who knows what type of results. I don't think the market's gotten complicated. It is from the standpoint that I have to know a lot more things now than I did 20 years ago because there's so much more out there. I also have a higher net worth clientele now than I did when I started 30 years ago. Just because people are higher net worth and they have tax problems and they have other issues that didn't exist 30 years ago on a very high level or very frequent basis. It's gotten probably more complicated for us in the business if we want to be comprehensive financial planners and do a good job as a fiduciary. I don't think anybody who calls himself a fiduciary should only do one type of product like a stock and bond portfolio. I think that's it doesn't make sense to me when there's so many other things that could help a client reach their goals better than just a stock and bond portfolio that's at risk and that may or may not provide the returns that they need to live retirement on their terms and be confident about it, because most people can't be confident when it's market-based. Anyway, it's not complicated. Just spend a little bit of time learning about it. Find somebody you trust that does do the work like we do and let them fill the gap between what you know, what you understand, but understand enough. But there's always going to be a time when you're going to have to rely on an advisor that is far more experienced than you are, that has dedicated himself to find out what those options are and to provide the best allocation of those assets in a manner that makes sense for you. And when it makes sense, then you should move forward. But you'll find that there's a lot more out there than the typical brokerage community or whoever dealt with your 401k in the past. So keep them open mind, go out, do the work, and you'll find out that retirement planning isn't more complicated. It's more exciting and gives you a lot more peace of mind.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And if you are looking for a clear picture of your retirement in today's market, call 520-780-9059. Talk to Jeff here at Premier Retirement. Request your Premier Retirement Roadmap. No cost, no obligation. Once again, it's 520-780-9059. You can make that call right now. Leave your name, telephone number, and Shelley will call you back during the week and set up that appointment for you. No cost, no obligation. Entirely complimentary. Once Once again, 520-780-9059. We're also online at primrat.com. Jeff, time for a break. When we come back here on Premier Retirement, we've got listener questions and more when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you joining us each and every weekend for Premier Retirement here on 790 KNST. We're on the air for you 4 times a week. We're on Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sundays at 11 a.m. And as always, if you've missed any part of our program, you can find us online wherever you get your podcasts. Search for Premier Retirement with Jeff Hogan. You're going to find this show and all of our past shows so you can stay on top of your journey towards a confident retirement and growing your wealth. All right, Jeff, let's start it off with Howard in Rancho Pistoso. Howard says, what ideas do you have for setting something up for my grandchildren ages 4 and 2? They don't sell savings bonds at banks anymore. Silver and gold bars are a little out of my price range. I'm on a fixed budget, but I want them to have a little something. I've already listed them as beneficiaries in my 401k. I'm wondering what people usually do for their kids or grandchildren. Now they're ages 4 and 2, Jeff. What do you suggest?
Well, yeah, some people do like a mini LIRP or a life insurance policy that they can grow up and take over, if they need it when they're adults. There might be some cash accumulation component to it. Life insurance is really cheap for a healthy young kid, but you can't buy a whole lot of it. If you're on a fixed income and only have a little bit of money to put in there, that might be an option. I'm not really a fan of 529 education plans. I think you're better off just using the 401k money. And honestly, what most people do, if you're asking what most people do, most people just list the grandkids as an heir to a piece of the profits or proceeds on an account like a 401k or IRA or a Roth if they want tax benefits, or even a life insurance retirement plan. If you're healthy, you could get life insurance on yourself and it could be payable tax-free to them. If you're still living when they go to college and you want to support that, you could borrow from that life insurance plan and write checks to the bookstore for tuition, things like that, depending on how much you have to put in. So everybody's definition of limited budget is different, so I'm not really sure how limited it is. But life insurance is one thing some people do, but mostly they'll just put the grandkids on as beneficiaries, either in a trust where they leave all their accounts to when they pass away, and then the grandkids would get a piece of that. There would be trust assets that could be used for their education or health benefits until they're age 25 or 30 or something. You could do that with a trust document, do more of an estate plan that would indicate where a piece of that action goes. Honestly, it's a little cumbersome to just open a tiny little account and try to manage it with fees and minimum account requirements and things like that for a kid. There's what's called an UGMA, or Uniform Gift to Minors Act, or UTMA, Uniform Transfer to Minors Act, where you can put money in the kid's name, and when they're 18, they can transfer it to themselves and manage it themselves if you want to do that. But it's a gift, so technically, even though you're a custodian until they're 18, you can't really change your mind on that. It's kind of gifted away. I like just having them on as a recipient or a beneficiary on a piece of something that you own, because if something happens along the way, they become irresponsible, they pass away, they get sick, they become disabled, they can't really use it for certain things. You could either up the benefit to help them because of a disability or other situation, or you can reduce it because they don't need it, because they're on state help or something like that, or they're passed away, or they've got some addiction issues and you don't really want to hand them a boatload of money when you die, because maybe reignite a problem that might have gotten fixed over the years. So you can be in more control keeping that account in your name and leaving them as beneficiaries. So I think you're already on the right track, and that is what most people do. I mean, a vast majority of people do. In my experience, it's a very minimal amount of people that actually do those transfer to a minor type account.
Howard, thanks for listening to us in Rancho Pistoso. And of course, if you want more info, call Jeff here at Premier Retirement, 520-780-9059. And of course, we're also online at premret.com. Okay, Jeff, let's jump to Samantha listening to us in Tucson. Samantha says, I just received a life insurance payout on my father's account of $600,000. I have a mortgage of $450,000 at 6.75%. My question to you is, should I use the $600,000 and pay off the $450,000, or should I keep the mortgage at 6.75% and invest the rest? What is your opinion on that?
All right. Well, that's an interesting question. If you're confident in making more than 6.7% on the mortgage, or if you have enough deductions to where that mortgage is actually a write-off that can be offset with taxes, maybe your net out of pocket's really only 4% on that mortgage. So it really becomes a question of arbitrage and if you can make more on that money. If you're a CD person where you're going to invest that money at 3 or 4%, because you just really don't want to lose it, it's a nice little tax-free gift, and you want to increase your cash flow by basically getting rid of your mortgage. I mean, if it was 2 or 3%, I'd say keep it all day long. But at that rate, 6 plus is anything over 5, actually, I think is kind of where you have to make that decision. Do I want an equivalent rate of return that's at least 5? Maybe what you do is pay off the mortgage, the 475 that's left. You have about 150 left after that. And you just go real aggressive on that money. So you don't have to be that safe because you have that extra $2,000 on your house or $3,000 a month that you're not, actually probably more than that on 475 at 6%. I'm guessing your payment's got to be $2,500 or better. So you might be just living on that extra cash flow, and that's cash flow that you could continue to invest in something else for your retirement or for future income. So I don't know that, again, if it's a high rate interest, pay it off. If it's low rate interest, probably less interested in paying it off. You certainly don't want to go and refinance it just to get a lower payment, because depending on when you finance that house, seems like it probably was recently. Refinance isn't even an option probably. So again, it just kind of depends on your risk tolerance. If you want to kind of balance it out, maybe pay it off because that's really nice to get out of that mortgage, and invest the rest and grow it to another $600,000 or $800,000 in the next 10 or 20 years if you invest it right. Or, if you do end up making bad decisions and lose it, at least your house is paid off.
All right, Samantha, good question. We appreciate you listening to us. And again, call Jeff at 520-780-9059. We can take a little bit closer look at that. But you're right, Jeff, at 3 and 2.5%, it's probably a no-brainer. But with 6.75%, it requires a little more examination. Okay, Jeff, let's go to Bill listening to us in Green Valley. Bill says, should I fully fund my Roth IRA at the beginning of the year or over the course of the year, and why?
Well, it kind of depends. Whenever you think the market's going to be the lowest, and if you think the market's going to have a good year, it'd be smarter to fund your Roth at the beginning of the year, because then you get the whole rest of the year to capture those gains tax-free. So if you think we're in a bubble and it's going to sell off, maybe you take a deduction on those IRAs and you kind of wait for the market to correct, and then you roll it into a Roth when it's low. If you can time the market, if you really think your crystal ball has that in store, I tend to think that would happen, but I don't know that I would necessarily bet my Roth conversion. If you're just doing a Roth IRA fund it sooner rather than later. I mean, the sooner you fund it, the longer you get those tax-free gains. By waiting, the only reason you'd probably wait is if you wanted to make sure you knew what your tax bracket was going to be at the end of the year, and maybe you don't need to fund a Roth. Maybe it'd be smarter to have a tax deduction because you ended up with a good fourth quarter. And you say, gosh, I really don't want to pay taxes on that Roth that I just put in beginning of the year. I should have just put it in my regular 401k or my regular IRA and at least wrote it off and saved a couple thousand in taxes. But now you have to pay the couple thousand in taxes and you're out the money, and maybe the market's on the brink of a correction and you're out the taxes and the market didn't do that well. So again, there's plenty of reasons to wait. There's plenty of reasons not to wait. It just depends what your overall picture looks like. But if you're working and you have a really unknown tax bracket where it could be high or low at the end of the year, I like doing all the tax planning at the end of the year, just basically for a good start for the following year. But if you're just withholding money and you do a Roth every year, regardless, just because it's part of your plan, I would always fund it at the beginning of the year, just because 7 out of 10 times the market's going to go up in a calendar year. So you got a good chance of making money by funding it at the beginning of the year and doing better over time, doing it on a regular basis earlier rather than later.
Bill, we appreciate you listening to us in Green Valley. And once again, if you'd like to talk to Jeff, 520-780-9059 is the telephone number. And you can make that call right now if you want. Shelley will take your name and your telephone number, and Jeff will call you back. But you can come on in and sit down with Jeff as well, too, and talk about that. 520-780-9059. You can also find out more about us online at primrat.com. If you've got a question you'd like us to answer on the air, you can get it to us two ways. You can go to primrat.com, use the contact page there, or of course you can always call it in to Shelley at 520-780-9059. Jeff, let's shift gears here and talk a little bit about inflation and interest rates here in the spring of 2026, which is just around the corner. President Trump has said that he wants interest rates down to 1%. Wouldn't something like that, 1%, create inflationary issues, do you think?
Well, there's like a catch-22 really, because everybody wants interest rates down. If interest rates are down, people can afford houses again, cars. It really stimulates the economy. But, if the manufacturing isn't raised, or if the tariffs are raised to a substantial rate where even our imports now cost more, that would generate at least a little bit of scarcity or at least a supply demand curve issue. So we have to be careful. It's kind of like the Goldilocks deal is you want the inflation / interest rates just right? You just don't want them too hot, don't want them too cold. You want them just right. And what is that just right? Well, it all has to balance out with a bigger economic picture than just, hey, let's lower interest rates to 1%. If we lowered interest rates to 1%, it would probably cause inflation because if it went from 7% on a car loan to 1%, I think everybody's like, oh man, anybody was going to buy a car next year is going to buy a car right now because we don't know how long that inflation is going to go. All of a sudden, the car dealers mark the cars up 10 grand a piece because there's only limited stuff on the lot and they've got to wait for the next shipment that's being manufactured somewhere else in the world. It's not going to get there for a few months. So that caused kind of a feeding frenzy, especially if it drops fast. I think if it drops over time, slow but sure, and as we increase, and because as that demand curve increases, that the supply can keep up, I don't think it's going to be a big inflationary issue that much. It would be nice to get housing costs down. I think I'd really like there to be some sort of a healthcare thing. I can afford healthcare. I've done okay. But I'm looking at what my kids have to pay. And without those subsidies, the Obamacare was an abomination to healthcare. It just gave license with all the subsidies. It gave license for the insurance companies to charge whatever they want to and medical companies charge whatever they want to because they knew that nobody's going to be priced out of the health insurance market because there was always going to be subsidies. Well, now the taxpayers are like, wait a minute. Why do we have to keep paying subsidies? We're paying for everybody else's health insurance. And, the current government says, yeah, that's unfair. Let's make it fair. Just have everybody pay what they owe. Well, now, shoot, health insurance could be up to 20 or 30% of a person's paycheck anymore.
Sure, yeah.
So I think that's probably one thing we ought to focus on, maybe more than getting interest rates down. But if we got interest rates down, and you didn't have to pay so much on houses and you didn't have to pay so much on cars, maybe health insurance will be a little bit more affordable. So it all flows together. I want a robust economy. I want the stock market to go well. I think certainly the stock market loves low interest rates. And if interest rates went back down to 1%, I think we'd just be setting us up for another Biden economy where the inflation catches up to us and one bad hiccup with either another virus or some shutdown would put the brakes on production, manufacturing, and all of a sudden we have another inflation period. I think Trump is a smart dude. I think he also wants to look good. So I think he's probably having to balance his ego and what he looks like as president and what the GDP looks like and the growth looks like and the talking points he can say in his next State of the Union speech, maybe more than the next 4 or 8 years after he's gone and what might happen then because we essentially pump too much money in the economy because lowering interest rates essentially is printing money. And yes, definitely is inflationary. 2%, 3% probably is a good rate. 0%, man, deflation, stagnation, falling prices, wages are going to go down. People, delay spending because interest rates are lower. They wait for them to go down at 4% or higher. Sometimes affordability is an issue and people want to hurry and get it before the prices go up. There's a certain happy medium. I think probably the 2 or 3% level that I think would be a more fair rate that would keep people's savings growing at a clip probably in line with inflation, yet give people an opportunity to buy things that they haven't been able to buy in a few years.
Jeff, currently inflation is running about 2.5%, something like that. And of course, it's going to vary a little bit. What should retirees be looking out for this spring as far as inflation goes? I mean, cash and fixed products are most vulnerable to inflation, aren't they?
Well, yeah, but if we can keep the interest rates, even on safe money, equivalent or close to the same thing as the inflation rate, then at least you're not losing money by saving. And if you want to gain money, there's still principal protected products that are indexed to stock market and other things that'll very likely and historically have beaten the typical CD rate of 2 or 3 or 4%. So there's still ways to safely make money, keep ahead of inflation. What I don't like is a 0% CD when inflation's still growing at 2.5%. I mean, you're effectively losing money every year because the only thing going up is going to be your Social Security at maybe that much, maybe not. And although those payments might increase a little bit, you might be shedding some of that off in taxes, depending on what it is you need to buy. The inflation might not be at 2.5%. It might be 4 or 5% based on what you're buying. It might be closer to 0, just depending. But typically, we want the interest rates and inflation to be kind of in line. But right now, interest is a little higher than inflation, which means the CD can actually grow better than inflation right now. But I don't think those days are going to continue too long because I think there is pressure to lower those interest rates. I think it'll get back down to kind of in line. But again, depending on what your risk tolerance is and depending on what you want to do with your invested money, you have to look at the options available. If you want to keep ahead of inflation, we like inflation low, right? If we want to keep ahead of inflation when inflation's high inflation is typically a drag on the market. Maybe you really can't afford to, or you're scared to be in the market, lose money if interest rates are high, yet you can make more on a CD. So it's kind of a catch-22. I think we need to find some happy place in between where the economy can thrive, where our kids can still grow into the lifestyle that we had 20 years ago or 10 years ago or up to just recently and maybe even currently. But our kids are going to have a much harder time with an increasing interest rate environment and increasing inflation than we did when inflation was really low over the last couple of decades, comparatively lower, and inflation was much lower. So again, I'd like to get back to the old days for just my kids' and grandkids' sake and get to some place where it makes sense for everybody, including retirees that need to make at least a little bit of interest to keep up with inflation.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. If you want a clear picture of your retirement in today's market, call 520-780-9059. That's the number to reach Jeff here at Premier Retirement and request your Premier Retirement Roadmap. No cost, no obligation, certainly 520-780-9059. You can also find out more about us online at primret.com. Jeff, as far as inflation goes, is inflation more dangerous early or later on in retirement? What do you think?
It hurts no matter what, but it kind of depends on what you're doing. I think I'd rather have inflation be really flat while I'm retiring and spending my money and playing with it and doing all my go-go year stuff. And if inflation happens when I'm in my 90s, not doing a whole lot of stuff where I'm spending money, then maybe it's not that big a deal. However, if you're in your 90s and the inflation is really hitting the medical community hard and the long-term care and assisted living and that kind of thing is going up like crazy, then you might be really wishing you'd had higher inflation earlier on and maybe been able to enjoy some better returns on your investments and savings and things like that to where you had more money in the later years than you would have had otherwise and to handle those higher costs. So I think it matters just when you need to spend the money or when you need to buy those things compared to how much you have in saving, what your net worth is and what your net spendable assets are. Again, I've said this so many times before. Most of your questions have an answer that fits for all of them, and that is, it depends.
Absolutely. That's why we invite people to call 520-780-9059 because one retirement plan doesn't fit everybody. There's no cookie cutter approach here at Premier Retirement. Once again, 520-780-9059. Jeff, we often talk about the Premier Retirement Roadmap in this radio program. In the few minutes that we have left in today's show, can you tell us a little bit more about what the Premier Retirement Roadmap really consists of when people do call 520-780-9059 and request that? What happens? What is this all about?
Well, it's a comprehensive look. It's what you said earlier about retirement getting more complicated. Well, it ought to be. Most people have a bigger estate. They have more things to affect their lifestyle. They've got long-term care to look at. They've got taxes to look at. They've got income replacement from their job to look at. What's the inflation picture look like? How are we going to keep up with that? Do we want to leave a legacy? How are we going to take care of that? Take care of my kids, grandkids, and leave them something if I don't spend it all? Or maybe I just want to spend it all because I don't have kids or I don't like my kids or I already set them up. I gave them a PhD at Harvard and they've got their inheritance already, whatever. Everybody's got a different situation, but whatever your goals are, there's a comprehensive plan that consists, in our opinion, of 5 pillars of planning. The 5 are investment planning. Make sure your investments either continue to protect those assets that you've worked a lifetime to acquire and that you don't risk any more than you can afford to risk and that they generate enough income to guarantee or to come close to guaranteeing at least your minimal net return that you need to spend on your budget, your bills. Basically, make sure your bills are covered, not just, well, my bills are covered if my investments work out and at least average 8% a year, then I'll be okay. Well, maybe that's not the approach you ought to take. Maybe we look at these income products that guarantee income so that you can be less worried about the money that you have in the market that you still have in. Even stocks and bonds, by the way, go down. We've learned that. Look at the bond market over the last few years, still under their highs by a long shot, especially the longer term bonds as far as price goes. So if you had to buy a bond a few years ago and sell it today in order to cash in and spend some of that money, because I'm guessing 2 or 3% on that bond isn't really paying your bills. So you do have to liquidate from time to time. You're locking in those losses of 10, 20%, even still from the highs a few years ago. So you can lose money in bonds, you can lose money in stocks. What else is there to guarantee the income and give you that peace of mind? Well, we talk about income products. We talk about tax planning with those income products. Do we take money out of our IRAs first? Do we save it for last, kick that tax can down the road? Do we convert to a Roth? Do we generate tax-free income now? Do we generate tax-free income later? Do we balance it between a little bit of tax-free and a lot of tax-free later and a little bit of taxable income now? Or do we want to just pay all the taxes now or pay most of them now or in the next few years and then never pay tax again? That's a question that we need to go over in that tax planning portion of that retirement plan. And then what happens if you get sick? What happens if one of you passes away early? Are you going to lose pension income? Are you going to lose enough Social Security to make a difference in the way the survivor's lifestyle is going to be? And do we have to set up a plan to provide for that as a contingency plan? What if you don't both live 20 or 30 years? Maybe one of you only lives another 5 or 10. Maybe both of you live 30 or 40 and there's 2 mouths to feed till you're 100 years old. We've got to plan for all the different contingencies. And I think a stock and bond portfolio really doesn't do that. It's really just a hold it and hope and pray that it works out type of a plan, where ours is more calculated. Some of it's guaranteed. Most of it's at least predictable, and predictable not in a aggressive way, but in a very conservative way, where it's easy to beat with just modest gains in the market and reasonable returns and reasonable interest rates going forward. So once we've taken care of the investments, making sure that they generate income and make sure they generate growth, and we look at how they're taxed and minimize your taxes over the life of the plan, not just this year. Your accountant wants to save every penny in taxes this year and doesn't really worry about the next 20 in most cases. We worry about the next 30, and we don't care if you have to pay more taxes now, because you're probably paying taxes at a lower tax bracket on less money now than you would 10 or 15 years from now when your assets have grown, when possibly the tax code has changed brackets and those brackets are now higher. I don't think the tax brackets are going to go down. I think they're more likely to go up. I think most people are in that same camp, even the ones that, depending on what, doesn't even matter what side of the political aisle you're on. I think everybody agrees that to balance budgets and to do all the crazy things the government wants to do with our money is they want to get more money. So it's probably going to be a higher tax bracket in the future, and it's better to pay taxes now. Then what do you do with those health issues, or somebody dies early? And then what do you want to leave? How do you want to leave it to your heirs? Do you have enough to worry about estate taxes? Then we need to do some trusts and some things that freeze your estate or doesn't allow it to go into those estate taxable areas. Do we use charitable gifting? Maybe. Do we use trusts that keep everything in your control? Yeah, probably more likely. Do we use tax-free accounts? Yes, as much as possible. Does that mean municipal bonds? No, not very often. Other things that are much more tax efficient. And then do you have a trust? Do you have beneficiaries on everything? Are your assets going to pass to your heirs without trouble, without taxes, with minimal amount of pain and suffering for them? And just decide to do that efficiently. So basically, those are the 5 main pillars: the income, the investments, the taxes, long-term care or health, and the legacy plan. And if you can kind of see how those all fit together, you see a plan, you feel comfortable with it, you can retire on your terms with a lot more confidence.
Great points there, Jeff. I want to talk to our listeners here for just a moment. If you want to preserve your wealth so that you can have a better retirement, if you want to create an income stream that you can count on, if you want to reduce taxes, the Premier Retirement Roadmap may be the answer for you. Once again, no cost, no obligation for this roadmap. Call 520-780-9059 and leave your name, telephone number. Shelley will call you back if you're listening this weekend. If you call during the week, Shelley will talk to you personally and set up that appointment for you. Again, no cost, no obligation, entirely complimentary. 520-780-9059. You can also find out more about us online at premret.com. Well, Jeff, out of time for this week. I want to thank you for your time, but most importantly, as I do every week, I want to thank our great listeners here in the greater Tucson area for joining us. So for Jeff Ogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.